January 04 to 2023. If you only missed 10 of the best days out of 5,033 trading days, it went from 11.8 annualized to 4.6, and so on. But the worst part, if you missed 40 trading days, the best 40 days out of over 5,000, instead of an 11.8 annualized return, it was negative 1.3%. It was 5 years ago, like this week, when COVID hit and they announced everything was being shut down. The market took a massive drop.
34% overall.
Quickly.
It only took 33 days to fully recover.
Well, we know it finished up very high, some good double digits for the year. So you saw a massive swing, and the people that sold out probably did not get back in within 30 days. And they missed a gigantic upswing.
Today's episode is brought to you by Security Financial Management.
Ooh, welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here as always with Austin Fats-Jacks and Mitchell Walk. Gentlemen, let's crack it.
A whole lot's cracking. We don't know. There's a lot going on.
There's a lot of that going on.
It is very busy in the financial world right now, so let's get right to it. Today's question comes from Zach from Mobile, Alabama. Zach, what you got for us?
Hey guys, today's question is, what is your advice for the average day investor in a volatile market? Should I look into making changes?
Thank you, Zach. Gentlemen, take this over, please.
Well, to answer
I'll
that,
let you start, Mitch.
you're going to let me start on that one?
Please,
Well,
please.
there was a lot of market volatility, which is Zach's big question. And we've seen uncertainty. We really haven't seen swings like this every day or every other day. But what's important is for people to really not make knee-jerk reactions. And a lot of times when we have these uncertain times, you get calls, should I just sell everything? Should I not sell everything? Well, first of all, if it's not an IRA, you may have some tax consequences, right, Austin? Tell them about that.
Yeah, absolutely.
The cap
I
gains.
mean, it's, people's gut reaction sometimes is to move everything to cash, but that move could create a pretty large tax consequence. For instance, like you said, non-IRA assets, if you have, just for round numbers, $1 million in equities, 500,000 of that is gains from being invested over a long period of time. If you sell everything, you're going to be taxed on that 500,000 of gains. And then you fight the dilemma of when to get back into the market. So you create a large tax bill, and then also you might be hesitant to re-enter the market where, eventually you do re-enter and you're entering at a point that's, higher than what you exited. So it gets tricky.
You essentially kind of lose twice, right? You sell, and then you
sell,
get back in.
You could lose twice, but
You're
also
taxed, and then you got to buy back in. You don't know.
Exactly.
Yeah, and it can be a lot. Now, again, we don't give tax advice because we're not CPAs, but you should check with your tax professional. But as an example, some people would pay a 15% tax, and if you live in Florida, there's no state tax. But if you don't, there's a state income tax on those capital gains as well. So 15% plus your state tax. Then it could go up depending on your salary. You could add another 3.8% tax to that. So then it goes to 18.8. And if you're in the highest tax bracket, it could go as high as 23.8%. Plus, again, if you're in a state that has a state income tax, you would pay tax on top of that. So it could vary. And again, you need to check with your tax professional, but it could be anywhere from 15% to 23.8% for just federal capital gains taxes. So you could take a big hit, and you really need to evaluate all of that.
I think, going back to the question of what to do during volatile times, right? I mean, I think Mitch was alluding to it, but it's, what we try to do is build an allocation that, maybe doesn't experience the same amount of volatility as you would experience if you were in an equity-heavy index, whatnot. I think, there's – I don't want to get too political here, but there is a lot going on that is causing uncertainty in the market. And whenever there's uncertainty, I think volatility increases.
Right, because people aren't sure what's going to happen. So it does create uncertain times. But, here at Security Financial Management, as well as other companies, but we really do specialize in this side. We have a lot of options for managed volatility managers. We work with different managers. So some of the managers actually manage it to the volatility. So you still can get some equity returns. That's possible because, again, nothing's guaranteed. You can get some equity returns, but when things go down, you may not lose as much as large cap growth sectors and things like that. So there are some things to look at. It's never guaranteed, but they have worked well in the past, and past performance is not a guarantee of the future.
A big part of y'all's financial planning, right, is preserving wealth as well, which it means if you see volatile times approaching.
Well, we really don't look at it as much because it does change every 5 minutes. It's a moving, but the VIX is a volatility index measurement.
Okay.
And depending on, if it's 30 and above, usually that's a lot of volatility. If it's below, it's not as much volatility. We don't worry about it as much. We take it into account, but we don't make all of our trades based on that. What we really look at is each individual client. What's their risk tolerance? What is their appetite for volatility? What's their age? So we look at each individual client, and that's how we build an asset allocation portfolio, because everybody's different. Someone who's 35 has a lot more years and can take on usually a little more risk than someone who's 75. So that's how we look at it. But the VIX gives you an idea of what the market is thinking and how much volatility is going on at any moment in time, because it does change. Just like the market changes.
So how do you calm people's nerves during these volatile times? It can get emotional, no?
Yeah, it can get very emotional, yes. And what we try to do, again, we take a look at their portfolio. We want to make sure it's diversified. We want to make sure the ratio of stocks or equities to fixed income is appropriate for their risk tolerance, their age, what they're looking for. Again, someone 35 may be saving money because they want to buy a house in 3 years. So they're not going to have, the same risk tolerance as a 35-year-old that doesn't need a big chunk of their money in just 3 short years. So we take all that into effect, and we really try not to let them make these crazy knee-jerk reactions.
You need to relax.
According to Fact Sheet, this is it's a very interesting report FactSet had put out. So they took patience and commitment would be one. And from January 2004 to December 2023, they took a look at the annualized return of the S&P 500. Over that period of January 04 to 2023, if there is total days of investment were 5,033 days, that's a lot of days to be invested, right? If you left your money alone in the S&P and didn't make any changes, and don't forget, you had 2008 when the market really was bad. You had a little dip in 2018. It was a little flat in 2014. The market, again, they took another big dip in 2022. If you did absolutely nothing and left your money alone, the S&P return, according to FactSet, was 11.8%. If you only missed 10 of the best days out of 5,033 trading days, it went from 11.8 annualized to 4.6, and so on. But the worst part is if you only missed 40 of the best days, because I have the others, but this is the one that's a real big number. If you missed 40 trading days, the best 40 days out of over 5,000, instead of an 11.8 annualized return, it was negative 1.3%.
Wow.
Just missing 40 of the best days over that long period and 5,000 days.
So it really speaks to, what we were talking about earlier, timing the market. It's very, very difficult to, ideal scenario, you get out at the top, it goes down, you get back in at the bottom. But
buy
like
low, sell high.
Yeah,
right?
exactly. But like you said, there's a lot of emotions involved when you're dealing with people's money, and I think it's telling that if you were out during that time, it makes up a very good chunk of your average annualized return. And the problem is, around those best trading days are also some of the worst trading days. That's where those volatile times people get a little bit spooked, but that's when you don't really want to make these big knee-jerk reactions and make a move to all cash, for instance, because a lot of times when it's volatile, when times are uncertain, that's when you experience some of those best days. So I think it speaks to building an allocation you're comfortable with on the front end, kind of build the ship where you think it's able to weather some of the choppy waters and just kind of grind right through it. Obviously, we can make adjustments, but it is, it's hard to time the market, and that study is very telling of that.
It seems like
just missing a recent one, a really good example of that was 5 years ago, like this week, when COVID hit and they announced everything was being shut down. The market took a massive drop, and I forget the number.
10% in
S&P
one day.
dropped.
One day, and overall it dropped
34% overall.
Quickly.
It only took 33 days to fully recover.
And I think the market finished. Well, we know it finished up very high, some good double digits for the year. So you saw a massive swing, and the people that sold out probably did not get back in within 30 days. And they missed a gigantic upswing.
Right.
And you look at 1987, the Black Monday crash, we saw 22.6% drop in a single day. It was the worst record to date. But at the end of that year, at the end of 1987, that year we ended positively. Yeah. So it's basically just, I feel like you're almost managing human nature to just pull out and
a lot of it is behavior management, but also understanding people's risk appetite prior to times like this. We try to really get a good gauge of how they might react in these type of situations and try to remind them of that as well. That's part of the planning process, the planning cycle is, hey, we build this stuff knowing that these times are inevitable. You just don't know when they're going to happen.
And it's not a loss until you sell, right? So it's a paper loss technically, but the second you sell, now you lost, right?
You've locked in the loss.
Yeah, you've locked in the loss. So be patient. All right, Zach, I hope that helps. Remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.